July 1, 1991. Real Estate Capital Basics, Underwriting Standby Commitments. Key standby commitment underwriting is structured as follows. Pricing. Overall yields, including IRR and coupon rates, are at 100 to 500 basis points above senior debt. Extremely entrepreneurial properties carry coupon rates as high as 800 basis points or more. Greater than or equal to coupon rate of senior debt, wraparound. Same flexibility as senior debt. Floating rate, graduated and fixed rate structures are available. Term. Flexible, varying with the underlying senior debt. Typically 1 to 15 years. Most common term is 5 years or less. Typically less than or equal to term of senior debt. Amortization. Flexible, ranging from 10 to 35 years, depending upon the existing senior debt terms and effective age of the property. Interest only available for terms of 5 years or less. Graduated payment schedule available at intervals of 2, 3, or 5-year terms. Debt service coverage. Below senior debt based on combined funding. 110% to 125% based on cumulative debt service payments. Dips below 100% in cases with substantial cash flow increases occurring within the foreseeable future. During low interest rate cycles, more dollars are available as coverage calculation generates greater leverage. During high interest rate cycles, less dollars are available as coverage calculation, not leverage, governs funding limits. Leverage. More than comparable first mortgage debt based on cumulative funding. Normally 75% to 80% of appraised value based on cumulative funding. In excess of 90% of appraised value based on Q and funding in situations with substantial cash flow upside in the foreseeable future. During low interest rate cycles, leverage, not debt service coverage, will govern cumulative funding limits. Funding amounts. $1 million or more of new funds is the usual minimum, especially with smaller banks and lending institutions. $5 million or more of new funds is a preferable range by institutional capital sources. Prepayment penalties. Prepayment disallowed, or heavily restricted, in most instances. Declining balance penalty comment, for example 5% year 1, reduced 1% annually. Yield recapture premium based on the profit spread between the current rate, or index, and the coupon rate multiplied by the number of remaining years on the loan. Funding timeline. Immediate funding of 30 days to 120 days is most common. Forward delivery available as much as 2 years with substantial pricing premium. Financing fees. Highly negotiable, depending upon lending source, borrower relationship and turned capital availability. 1% to 3% for additional funds based on larger loans of $10 million or more. 4% to 10% for additional funds based on loans below $10 million. Property types. Most categories of existing income-producing properties qualify. Vacant land and new construction venture is considered on an extremely selective basis with debt service reserves built into loan underwriting. Substantial pricing premiums. Special features. For smaller loans, special purpose properties and other management-intensive assets, personal guarantees are required. Discounting as much as 5% required in some cases, especially when capital market options are more limited.